Hey everyone, and welcome to the channel. If you're into deep dive technical analysis like this, do me a favor and hit that like button and maybe drop a comment below. It really helps the channel out. Today, we've got a wild one. We're going to look at the anatomy of a complete and total stock collapse. The stock is CGET, and we're going to perform a full post-mortem, digging through the technical data to find the warning signs that were flashing bright red way before the end. Let's get right into it. So how on earth does this happen? I mean, how does this stock just completely evaporate, losing over 90% of its value in just a matter of weeks? It's the kind of thing that keeps investors up at night. This wasn't just a slow, gentle decline. No, this was a free fall off a cliff. And the data tells a really fascinating and, frankly, a cautionary tale. So let's unpack what really went down. Just look at that number for a second. Let it sink in. Negative 90%. That's an almost complete wipeout of shareholder value. Gone. It happens in an incredibly short amount of time. You know, this isn't just a market correction or a bad quarter. This is a fundamental structural failure of the stock's price. And this timeline really shows you the sheer speed of the collapse. I mean, it is just staggering. We're cruising along at over $2 a share in June. By August, a serious downtrend is starting to set in. But the real implosion, the main event, happens in September. It goes from $1.64 to less than 18 cents in weeks. This right here, this is the what happened. Now we're going to get into the fun part, the why.
All right, let's kick things off with section 1. Before we get into all the nitty-gritty indicators and the math, let's just zoom out and look at the big picture here. We need to understand the basic shape, the basic pattern of this collapse.
You know, this is Technical Analysis 101. What we're seeing here is a classic textbook breakdown pattern. The easiest way to think about it is like a ball bouncing down a flight of stairs, right? Each time it bounces, the peak of that bounce is a little bit lower than the one before it. That's your lower high. And each time it lands on a lower step. That's your lower low. It's a crystal clear signal that the sellers are in complete, total control. They're just relentlessly pushing the price down. Okay, section 2. Time to put on our detective hats. This is where we start digging into the technical clues, the stuff that's buried in the trading data, to really understand the forces that just drove this stock right off a cliff. Now this table, this is where the story gets really interesting. You gotta remember, volume is everything. It's the fuel behind any price move. So look here, on September 3rd, 48 million shares trade hands as the price just collapses. But then, get this, on the 19th, an absolutely mind-boggling 1.7 billion shares are traded. When you see gigantic volume spikes on down days like this, it's a huge red flag. It tells you that the big money, the institutional players, they are sprinting for the exits and dumping every share they can. The selling pressure is just immense. Moving averages are great because they smooth out all the choppy day-to-day noise and show you the real underlying trend. And in this case, the trend is painfully clear. The stock isn't just a little bit below its short-term 5-day average. No, it has crashed far below its 50-day and even its super long-term 200-day average. When you see all of the averages lined up and pointing down like this, it's a unified signal. It's like every current in the ocean is flowing in one powerful bearish direction. So you might look at a chart and see that the relative strength index, the RSI, is down here at 30.41. And technically, that's oversold. And a lot of people think, aha, it's oversold. It's got to bounce. Time to buy the dip. But wait, this is a classic trap. Oversold does not automatically mean buy. In a powerful downtrend like this one, a stock can stay oversold or get even more oversold for a very, very long time. It's a flashing yellow light for sure, but it is not a green light to jump in. This slide basically puts it all together. It's like we're looking at the dashboard of a crashing airplane, and every single light is blinking red. On the left, you've got momentum indicators, like the MACD. They're telling us the downward speed is accelerating. Then on the right, you've got trend strength indicators, like the ADX and Arun. They measure the horsepower behind the trend, and they are confirming this isn't some gentle slope. This is a powerful, high-force dive. Every single dial is pointing in the exact same direction. Down, and with serious conviction. And hey, if all those indicators weren't enough for you, the pure math tells the exact same story. A linear regression analysis gives us what's called an R-squared value of over 0.72. Now, in simple terms, all that means is that over 72% of the stock's price drop can be explained simply by the passage of time. This isn't random market noise. It's a predictable, statistically significant, persistent decline. The math doesn't lie. So we've clearly established that we're in a powerful, data-backed downtrend. Now for Section 3, let's map out the battlefield. We're going to look at the key price levels where the next fights between buyers and sellers will happen, and we're going to get a feel for just how incredibly volatile this stock has become. The best way to visualize these levels is to think of them as ceilings and floors. For the price to recover, it has to break up through several ceilings. Those are your resistance levels. We see an immediate one at 20 cents, another at 25, and a major one at 30. But below the price, you have floors, or support levels, that might stop the fall. The first potential safety net is at 15 cents. If that floor breaks, the next really critical psychological level is down at just 10 cents. Okay, now for a number that should really make you sit up and pay attention. 0.1238. So what is this? This is the stock's average true range, or ATR, and it's a pure direct measurement of one thing: volatility. And an ATR of over 12 cents on a stock that's trading for less than 18 cents is, well, to put it mildly, it's extreme. It means the stock's typical daily price swing is almost 70% of its total value. Think about that. That's the very definition of an unstable, high-risk asset. The price swings are huge and completely unpredictable. This bar chart really drives that point home. It shows that based on that extreme volatility, on any single day, this stock could plausibly swing from a low around 5.5 cents all the way up to a high of over 30 cents. I mean, that potential range is just enormous, and it screams extreme uncertainty and massive risk for anyone involved. Okay, we've gone through all the evidence, we've looked at all the data. This brings us to Section 4, and the most critical question of all: what happens next? The technical analysis points us toward 3 possible scenarios. So here are the 3 most likely paths forward. First, you could get a classic dead cat bounce. That's a short, brief rally that gives everyone false hope, sucks in some buyers, and then promptly fails at that 20-cent resistance ceiling and rolls over. Second, the downtrend just continues. It breaks that 15-cent floor, and the fall actually accelerates down toward 10 cents. Or third, it does nothing. It just goes into consolidation, trading sideways between 15 and 20 cents while it catches its breath. So, which of the 3 is the most likely? Well, given the absolutely overwhelming weight of the evidence, the insane selling volume, the trend strength, all the moving averages pointing down, the analysis concludes that scenario 2, continued downside, is by far the most probable outcome. The bearish momentum is just way too powerful to ignore. And this really brings us to the final, most important takeaway. And just to be clear, this is not investment advice. It's simply a direct conclusion from all the technical data we've looked at. Every single indicator is sending the same unambiguous message: this is an extremely high-risk situation. And right now, there is zero evidence that a lasting, sustainable bottom has been formed. And that leaves us with this final critical question. It's a question that every investor has to ask themselves when they're looking at a stock that's been absolutely crushed like this one. When you see that first little glimmer of hope, that first green day, how do you tell the difference between a real bottom and a bull trap? It's the hardest question in trading, but as we've seen today, if you know how to decode the data, the clues are always there.